Welcome. Today, we're doing a deep analytical review of Taiwan's semiconductor manufacturing company. We're going to focus on its recent performance and, more importantly, the fundamental structural shifts that are reshaping its entire business. We're going to begin with our core conclusions right up front. Our analysis shows that TSMC's recent outperformance isn't just about the industry getting hot, it's driven by company-specific strengths. We're seeing a massive transition to AI as the main growth engine, a technology lead that's actually getting wider, and financial results that are clearly accelerating. Over the next few minutes, we'll walk through the data that backs all of this up. Here's how we're going to break it down. First, we'll quantify that market performance. Then, we'll dissect the Q3 financials that really lit a fire under the stock. After that, we'll dive into the rise of AI, assess the competitive landscape, and finally, we'll wrap up with a clear-eyed look at the key industry risks. So, first up, let's put some hard numbers on that recent stock performance. Okay, just look at this period between early September and mid-October of 2025. TSMC stock surged an incredible 31.6%. That didn't just beat the market, it absolutely dwarfed the broader S&P 500 and even the semiconductor-focused SOX index. And this is the key number to focus on, the alpha, or the excess return. It outperformed the S&P 500 by over 28 percentage points and its own industry index by more than 10. Now that is a powerful signal that this rally was driven by factors unique to the company, not just a rising tide lifting all boats in the sector. So what was the catalyst for this reaction? Well, it all goes back to the company's third-quarter earnings report. Let's really dissect the key metrics that drove this confidence. Let's start right at the top line. Q3 revenue hit $33.1 billion. That's a remarkable 40.8% year-over-year growth. But what's really crucial here is that this number blew past not only the company's own guidance, but also the consensus expectations from the market. And the profitability story was just as strong. Gross margin came in at 59.5%. A number like that reflects incredible efficiency, high use of their most advanced factories, and really tight cost control, even while they're expanding all over the globe. And it continues with the operating margin also beating guidance at 50.6%. When you see both gross and operating margins coming in ahead of expectations, it sends a powerful signal about the company's operational excellence and its pricing power in the market. But perhaps the most important signal to the market was this. The company raised its forecast for the entire year. Bumping up the revenue growth outlook to the mid-30% range was a clear sign of management's confidence that this momentum wasn't a fluke, it was sustainable. And this table really puts it all together. You can just see the trajectory. Look at the revenue line, from $23.5 billion just 1 year ago to a guided midpoint of nearly $33 billion for Q4. At the same time, both gross and operating margins are consistently expanding. The guidance even suggests they could hit a peak gross margin of 60%. It's this combination of accelerating growth and expanding profitability that really solidified the market's confidence. This brings us to what is really the central theme of this whole analysis, the fundamental shift in what's actually driving TSMC's business. And the answer, without a doubt, is artificial intelligence. Now, first, a quick definition, just so we're all on the same page. When we talk about high-performance computing, or HPC, we are primarily referring to the hardware that powers AI infrastructure, things like AI accelerators and high-end server CPUs. So look at where the money is coming from. An overwhelming 74% of revenue in Q3 came from their most advanced technologies, 7 nanometer or better. And why is that so critical? Because these are precisely the nodes needed for the most demanding applications in the world, especially for AI chips. And this chart right here, this visualizes the historic shift. For the first time, the HPC platform, at 57% of revenue, is now nearly double the size of the smartphone segment. This marks a definitive transition. The company's growth story is no longer tied mainly to the consumer smartphone cycle. It is now structurally linked to the long-term, massive build-out of AI infrastructure. And this isn't just our take. This view is captured perfectly by a recent Morgan Stanley report, which called TSMC the only indispensable company in the AI supply chain. That really underscores its unique and pivotal position in this entire ecosystem. So, given this absolutely central role in AI, it's critical we assess the strength of the company's competitive moat, those structural advantages that protect it from rivals. For TSMC, that moat is really built on 2 pillars: technology leadership and sheer manufacturing scale. A huge part of that moat is a clear and relentless technology roadmap. Today, 3 nanometer is in full swing, but they already have a clear path to 2 nanometer in 2025, and then an even more advanced 1.6 nanometer process planned for 2026. This signals a pace of innovation that's frankly designed to keep them a generation ahead of the competition. And when we put that in context, you can see the dynamic. Yes, Intel is making strides with its 18A process, and Samsung is pushing ahead with 2 nanometer. But they each face their own unique challenges. And what's really fascinating is that Intel is still both a competitor and a customer, reportedly relying on TSMC for certain advanced components. That just highlights the deep, complex ecosystem that TSMC sits at the center of. Of course, no analysis is complete without a balanced view. So for our final section, let's turn to the potential headwinds and risks facing not just the company, but the entire industry. There are several key risk factors that absolutely require monitoring. First and foremost, geopolitical tensions surrounding the concentration of manufacturing in Taiwan remain a top concern. Then there's the risk of a global macroeconomic slowdown, which could always impact demand. Competition is heating up, with Intel and Samsung determined to close the gap. And operationally, executing these massive overseas expansions while keeping costs in check is no small feat. And finally, you always have ongoing risks like heavy customer concentration and cybersecurity threats. And all of this leads to a really crucial strategic question for the whole industry. Has the structural demand from artificial intelligence fundamentally broken the historical boom and bust cycle that has always defined the semiconductor market? You see, the very nature of demand is changing. Historically, this industry rode the waves of cyclical consumer electronics. But AI infrastructure? That's a structural driver. It's based on long-term corporate and national strategies. That demand is far more rigid and predictable. Now, AI doesn't completely eliminate the cycle, especially for consumer goods, but its growing influence acts as a powerful stabilizing force. So, we'll conclude with a forward-looking question. As the industry pushes beyond 2 nanometers, the very definition of leadership is evolving. The question is no longer just about who has the purest manufacturing process. It's about the complex interplay between that process, advanced packaging technologies, and the deep integration of a global ecosystem. The answer to that question will likely define the next decade of competition.